Yeah, excellent. So I'm just obviously we have a large audience of family offices. And so I'm curious if you can speak a little bit to maybe situations where you're seeing that family offices have an edge over traditional PE firms when it comes to M&A and where can they actually win?
What I'm seeing with family offices is the ability to show. What I'm seeing with family offices is the ability to invest for long term. What's happening with private equity, they want to see something rather quickly. And a lot of the founders that we work with who are getting ready to retire and put their legacy on the line are focused on what this will mean to them, whether it's going to be what it's going to be like for them with their family, with their legacy moving forward. And they don't like the idea of just looking at the numbers. They want to understand what's in it for them over the long term.
Excellent. Any additional thoughts there?
No, I think there was certainly, I think covered a lot of the advantages that a family office brings to those type of deals, and certainly echo multi-generational middle market companies generally tend to position themselves extremely well for family offices because, as I said, there are certainly some level of circumstances why they need to kind of exit as a family overall. And so generally, that's where I think family offices position themselves better than private equity.
I would add that where I see family offices could be successful is in being flexible and being able to pivot quickly. For example, you engage with the company, you're trying to get a deal done, you realize diligence doesn't support the valuation that the sellers need, but I would do a minority deal at that price. Can you pivot from a majority to a minority, from having control to sharing control, from acquiring the whole company and taking a small stake? With private equity, it's very difficult. They tend to be very specific about what they can do. And once they've taken a deal to committee once, it's hard for them to go back and say, look, forget about it. We're going to do it a different way. We'll just take a preferred stock. With family offices, this ability to kind of pivot and not be very institutional about it, I think could be an advantage with founders who desire a transaction, because sometimes there's just a need for a little bit of capital that can convince them to defer pursuing a full exit.
Yeah, I just want to reiterate that I think it's very targeted. You got to pick one word. Family offices, real estate, as we know, have brought in what you call a fractional CIO, people who understand real estate. Real estate, as we know, is locally driven. But from a PE standpoint, I see it in our practices and our competitors' practices. I think it's targeted in the sense that if the family office have made their money, let's say in industrial wealth, they'll understand an industrial deal. If they're in the energy space, they'll understand supply chain finance from the credit side or commodities transactions. For them really to venture outside of the industries they know well is a leap of faith. I think there's a speed element that brings a strategic advantage to get away from the competitive auction, so that I think family offices can compete on speed and a permanent capital base. Whether it wins on price or not remains to be seen, but I think it's really in your battles, and that's the word targeted there, of industries they know, rather than trying to be a generalist or everything to everyone.
Yeah, and so I'm interested what types of deals you're seeing right now that maybe aren't showing up in broad auctions, but they're still getting done kind of quietly. Any thoughts there?
I'll start. Right now we're working on a deal with a very interesting. It's a private equity firm that had purchased the football club in Europe, soccer team. And ultimately, they wound up doing great with the club. They moved it up on the food chain, promoted it up to the next level. And now there's a family office that I'm speaking to that's interested in either co-investing or doing a majority acquisition to move it up to the top of the food chain.
Excellent. Any other thoughts?
I think you have to look at certain areas that are asset light. Besides industrial, we work with a lot of business services, ad tech, marketing tech firms, which have been darlings of private capital, growth capital, and VC over the years, even though they're not very asset intensive. I think what's going on right now, we all know and familiar with what's going on with AI and consolidation, but with AI and the creative side, it's eliminating jobs, particularly in business services, professional services, and advertising, marketing. People are taking a second look at maybe consolidation or strategic buyers who can roll up and appreciate the talent that they're buying in a workforce more than the private equity firm. You look at the accounting industry, very hesitant initially of private equity, but as some deals have worked out, but it's you see sometimes your greatest asset are your intellectual property, your people. So I think it's really certain industries, if they can combine with strategic partners, they know that goodwill will roll over a little better, the workforce will roll over better. So I think some of the asset light deals I'm seeing, people are looking to not just PE as potential buyers, but also giving look to strategics, not only keep a more complete auction, but to have the ability to say to your workforce, it will be okay if you're acquired by a strategic, rather than have to worry about layoffs that could come from potential cost cutting in a sponsored transaction.
From my perspective, I guess very generally, I mean, when you look at the landscape in terms of the prevalence of private equity chasing deals, obviously family offices now participating in it, it's extremely difficult to obviously identify and participate in some of these processes, particularly when valuations are at the levels they are. So sourcing becomes a very critical aspect of any M&A. And so more often than not, you see sponsors, again, independent if it's private equity or family offices, that are proactively approaching businesses that are not actively for sale, with the mindset that, you know, any business is at some point for sale. It's just a matter of who gets to them first. And so particularly family offices, I think, as you indicated, that are very focused in certain industries, they kind of take that a proactive approach to reaching out to companies that may not necessarily be on for sale or being represented, and basically engaging in discussions to the effect of that.
You took the words out of my mouth. I agree with the proactive and sort of networking with specialist bankers and asking to be introduced to opportunities that are not in the market and finding how they can satisfy the needs of these companies. Another category is companies that are too sensitive for a broad process, where leadership understands that, where there's concern that a process that ultimately gets leaked is going to hurt competitive position of the business in the market. And so particularly with deals which are kind of 50-50 recaps, where you sort of stand to fight another day on the final exit, some folks value certainty and efficiency over the sort of less dollar, and they prefer to do a bilateral deal.
Yeah, and you touched on my next question, which is really deals and how deals are getting structured right now versus maybe, you know, a few years ago, or even going back to as far as 2021. So I'm curious what the panel thinks about deal structure.
I think maybe I start. So if we pick 2021 specifically, which was right after the pandemic, I think holistically speaking, you know, I guess the way that ultimately the sentiment was overall, I think for a lot of business owners, you know, there was certainly an aspect of understanding and realizing the challenges that the pandemic brought upon their own business. And so there was certainly a little bit of a rush to ultimately see a transaction being done. So there were ways to basically look at reps and warranties, kind of bring in insurance in the way of trying to expeditiously close out transactions. Nowadays, again, I think the biggest challenge is more or less valuations. So due diligence as a consequence is taking a little bit longer. And again, the sentiment certainly from a seller's perspective is no longer we need to rush the deal, which obviously is a big motivator to close them.
Right. I think that the overall theme is thinking about downsides, and maybe it's not structure specifically, but it's approach to negotiation, approach to due diligence, and like my uh, fellow panelists said, speed of getting to the deal. Was M&A activity down? More and more processes only have one buyer, and for the sell side, it's very difficult to hide that that buyer is alone, and they ultimately sense it, and like that process of submitting the final bid to signing extends, and sometimes these buyers understand that sellers don't have many other options, or at least don't have many other options today, and the kind of the final part of the deal extends, and it's challenging on the sellers because buyers want to make sure there isn't something else out there that they're really sure. And again, they tend to win on downside protection points.
I think from a structuring standpoint, again, not to beat a dead horse, but it's driven by industries and industry and target specific. If a company is throwing up a lot of cash, there's a lot of opportunity and leeway in how you structure equity versus credit. I think one of the things that's causing a little confusion in the structuring is alternative vehicles such as KISS equity or other types of equity that punts on the valuation issue. So you don't really know that capital coming in as equity, as a debt. It's sort of creating a little confusion. I think one of the things that I'm seeing, and we have seen in the past, 5 to 7 years, get to Claudio's point, is the surge in reps and warranties insurance is facilitating speed. People are closing, following the Sun Capital models in 60 days, 90 days. They're getting those term sheets, they're getting the deals closed more quickly. Problem is, it's not a panacea. If there's a deal blow up and your carrier is all of a sudden writing a check for $5 to $10 million back to the sponsor, they will grin and bear it, but they don't like it at all. So the next time you go and have a QOV screen for reps and warranty purposes, and a third firm comes in besides seller earnings quality diligence, buyer earnings quality diligence, that third party is going to have a different look at AR inventory depending upon the deal. So I think it's a double-edged sword. Speed is up. Structures are more fluid, particularly with more venture debt and growth equity, but you have to still get down to, I think, nuts and bolts. I think there's a heightened sense of due diligence needed when deals are closing quickly with the surge of reps and warranties insurance.
I'm inclined to agree. Overall, we're seeing due diligence taking much longer, and the purchasing parties are much more rigorous in what they're seeking and looking for overall.
Yeah. And so where are you seeing sellers prioritize legacy and fit over that maximum price? Any thought there?
Well, there's certainly businesses like that. They tend to be in industries like healthcare services of certain kinds, education, certain other types of services businesses. So typically in deals that are not 100% acquisitions, but sort of partial recaps, founders want to remain CEO for some portion of the holding period of a new investor and sort of shape the direction of the company in the 2.0. So they kind of took the company from point A to point B, maybe because of age or other factors. They can't quite take it from B to C, but they want to set the direction. And from what I've seen, many founders want to remain CEO for at least part of the next chapter.
I think, sorry, take it. I think fits an issue when you have roll-ups strategies, particularly PE, all the rage for, I wouldn't call it mom and pop, but let's say old economy interests, old economy sectors, HVACs, garage paving, these type of, getting back to family office, these type of businesses that are not obviously large middle market plays, but sort of like lower middle market roll-up strategies. and you're taking out a founder, and the goal is always, try to get in at 5-6 times EBITDA and sell after you do a roll up of 5 or 6 of these at 8 times. It makes sense from the number standpoint, but you need a good operator because these are boots on the ground businesses. They are service intensive. There's a customer service element, and they're often asset light. They're service businesses. There's not a lot of collateral, particularly if you're doing some sort of engineering and relevering the company. So I think the fit more than price happens when there's asset deals and you have to execute on a role play and really the platform build, really making that happen and really energizing the value proposition with cost synergies.
We wound up closing a deal, a manufacturing company in Europe a couple of months ago, and it was basically an auction between a private equity and a family office. And the family office wound up winning because of legacy, first of all. And second of all, the private equity was looking specifically at numbers. That was it. And the family office really got into what business was all about, what the vision was for the owner moving forward. And that really closed the deal for them.
Excellent. And so the other question I have is just given the macroeconomic environment and heightened competition for quality assets, what kind of key trends are you seeing in observing, family office M&A activity specifically?
Well, maybe I'll start quickly. I would say quality is more important today than it was a few years ago, where there was a lot of so-called FOMO. People showed up and bought businesses and thought that problems could be fixed with better management teams. I think the reality is bad business, good management team, bad business wins. And I think definitely buyers across strategics, sponsors, family offices looking for businesses that delivered consistent performance and growth. I think margins are more important than before. And the management bench is very important, and folks are looking at how professionalized the business is, and all of these factors matter more today than before.
I think, we know family offices making private capital investments. One of the major selling points is the stable permanent capital base. You have a long-term partner that's not there for capital appreciation, but stable growth, and they can be there and take the whole capital stack. They can provide equity, interim financing, credit. But I think one of the other areas family offices are winning is the ability to look at the investment and bring in the right people. I think if it's operating partners, that usually is what you get the advantage of a commingled fund, bringing together operating partners. But family offices are showing themselves to be able to bring in the right people, particularly in real estate. They bring in boots on the ground. So I think, family offices are competing on a variety of different ways. And I think one of the greatest opportunities, I think, in the next few years is this backlog. There's a big article in the Wall Street Journal in June about 30,000 companies, roughly $3 trillion in private capital that is locked up. And from the valuation side, people say, well, valuations are, more scrutinized because things are locked up. Family offices could come in and they don't have to worry about these concerns. They're in it for the long haul. They're not have to worry about reporting unrealized gains on audited financials. Yes, they have audited financials, review financials, but they're not done to satisfy 20 LPs or 50 LPs. They're usually a much smaller amount of investors, not one family office, one family power in the family office. So they're flexible in their reporting and they're flexible in their structure. And I think there's a lot of ways, particularly with evergreen funds, making a total need for a valuation bonanza. That's not an issue with family offices. They can wait and see and really try to harvest those gains without having to worry about interim valuations from that standpoint.
Yeah, Claudia.
Yeah, I think as we kind of talked about the legacy before, I think family offices are a little bit more prune and more tailored to kind of share an entrepreneur's vision in terms of where they want to see the business to go. Similarly, I think Igor or Chris, you guys said earlier, some may not necessarily be ready to fully exit the business. And so this gives them a great opportunity to, again, align the vision, what they anticipate with the business. So I think family offices definitely align extremely well as a partner or investor in those type of businesses.
Let me just add, I think the real alpha for family office is sourcing the businesses before they become available on the marketplace. We have over 100 advisors around the world that are doing just that, going out and meeting with founders and sourcing the deals. And the ones that wait for fancy SIMs and, audited financials, basically that's too late. By that time, everybody has seen the deal and it's been around the block.
Interesting. So,
So
go ahead.
The comment is that deals don't come to you with a nice little dividend after rent.
Sorry.
Right. There is a lot of families that are looking with the right looks that with growth capital, and in that growth capital sphere, we're looking for a couple $1 million of EBITDA. But with the condition that company will be sold in the next 5 years, right? So they're looking for rebuy. I like to think that's rebuy. Because a lot of them want to shy away from buyout because they're concerned, or the thought is that all buyout goes to auction. Is that safe to say?
I think certainly, from the aspect of trying to get companies before they are ready to go to market to be sold, certainly I think that is an accurate point to kind of raise, where somebody can go directly into a company, obviously assess and understand what the vision is and where the growth challenges for that businesses are particularly. And I think that a family office definitely would have that advantage over other sponsors in kind of looking to make those deals, particularly, I think, as Chris alluded to, and I know I speak very holistically, and obviously it always very much depends on what type of sector we talk about, but particularly family offices, like Chris mentioned, that have a background or have attained their wealth by selling their own industrial businesses. So where they have an extreme advantage in terms of what the marketplace looks like, what you need to do in order to put yourself in the position to maximize value. So yeah, Marty, I think, that certainly is a very good circumstance for a direct investment, and ideally trying to get ahead of before the selling process starts.
I just want to add, a lot of founders don't know where to go for small pieces of liquidity. And that's the family office market is it. Folks know about private equity. Oftentimes you have this bid-ask spread where founders want to sell 10 or 20% of the company to power the next phase of growth. Private equity says, we're either going to take majority or we're going to take plurality. And bankers are not educated about family office market and don't understand where to turn to help companies fill small liquidity gaps. And so I think the opportunity for people like you and for this organization is to promote the power of the family office networks with middle market bankers.
Saying a little bit, but the part of you're saying, and that family office can be flexible. They don't have to be flexible for one. Number two, a lot of that flexibility engendered by knowing who you're working with. And most entrepreneurs and businesses are really bad at creating that relationship. So if you look at like private equity and value add private equity firms, some of them get so big they don't really build good relationships. They might co-invest with independent sponsors, right? And the independent sponsors develop these great relationships with the companies. And then the other side is the family office who have capital. They're not going out of their way to really develop relationships. It's up to the company for the capital. And that's where the gap is, that there's a relationship valley.
Right. And the bankers are supposed to.
Right. And I think the bankers, particularly independent advisors, like the ones sitting on this panel, that's our job, is to bridge that gap. And oftentimes reaching into the family office universe is a shot in the dark, because there are some family offices that do direct investments. There are some that they say they do them, and then there are some that don't do that at all. And so finding the right family office, like you said, where there's a match, is difficult. And I think that's where the opportunity is.
And the other part of that is that it's also a situation that many times the family office that's known for doing a certain type of investment is illiquid, especially now. Because they're not getting any kind of money back from private equity folks they invested in. So there's a guy who has invested $50 million in cancer. I went to him with a great cancer product, and I'm a liquid. I'm not investing for 5 years. So I get something back, right? So it's more the Corinthian than you think. It's more of a maze again, but whatever. Well, I agree with you.
Yeah, so do I. We're starting to reach out quite a bit to family offices. Right now, we're doing quite a bit with private equity as well.
Just want to add one last thing. I agree with everything that's been said. I think you talk to a lot of M&A advisors. I'm curious for our panel's thoughts on this. And they will tell you when a company will get to 5-10 million in size, the PE firm owners, if it's owned by a sponsor, if they're going to do a secondary or spin it off or sell it a couple of years down the road, even if they were introduced to a deal by a banker, boutique, bulge bracket, they will put it out to bid a lot of times. And it's sort of weakening the traditional ties and deal flows from the sell side to the buy side PE sponsors. I think it's a tremendous opportunity for M&A advisors across all industries to really formulate relationships with family offices to take a little bit of the leeway and power away from the financial sponsor. Not that they're always going to be a part of the process. They're always going to be a large dominant player in the ecosystem, whether it's private equity or private credit. But having that opportunity to show a family office a deal before it's getting to Mari's point, overshot. And it hasn't been, percolating for 6 to 9 months across a distribution of 200 people on a full auction. Everyone's seen the sim or the PowerPoint. I think it's an opportunity for family offices to be targeted, but also formulate relationships with people, particularly on the sell side, to get those deals before they really make the rounds.
Smarter than ever before.
Correct.
Right. And that the overshot deals pre-2008, but post 2008, most family offices have some sort of advisor associated with them. So like saying, "Oh, that's overshot," or blah blah blah, whatever, right? And
But I think
I would expect there's going to be somebody, an analyst level person, sorry, going to talk to you.
but the opportunity is not on that side. The opportunity is, like you said, on the early side and the direct contact. And what I think family offices who are successful do or should do is hire folks who were, maybe like a founder operator and exited a business successfully. Those tend to be top hires for middle market private equity firms. They come in as kind of executive in residence. They preside over a deal and then they become CEO. Those would be great type of hires for family offices who want to make direct investments to help them navigate the space and learn and make inroads.
Okay, question.
I come to when I'm looking at people on approach the family office, so the family office is going to give someone an easy grant. And the first things I'll say, I'll say to the company when they come in, we'll go to the family office. It's like, you think they're going to be nice to you because they're from the family office?
Yeah. That's the word.
It's like yeah, exactly. So I wonder whether you've encountered this, whether there's a need.
So, I mean, certainly there are certain perceptions, I guess, when you look at a family office versus a private equity. And I think, as Chris has indicated, it really behooves the advisor, right? If the company elects to bring somebody in, to really identify how to place this business best, trying to understand entirely what the seller ultimately wants to accomplish. An exit, obviously, that's a given, but what do they expect from this exit, and do they want to be involved, and to which extent? So that comes back to the advisor. To your point, Yeah, I mean, there's certainly perceptions in terms of family office versus private equity, but I will say, because I've kind of been, again, I've been in this like many of my, the same as the panelists here, we've been at this for 20 plus years. And when you kind of take a very pragmatic approach, the middle market 25 years ago wasn't really a market that was targeted by any sponsors from that for you know, for very much. And so when you kind of look at 25 years of development, when people started to realize the value and the ability to benefit from investing into middle market, that's what kind of brought in a lot of sponsors, private equity, and it really kind of created a lot of processes and systems by which they kind of came about it. So when you look at the overall ecosystem of service providers, 25 years ago, you didn't have it. There is virtually so much service providers available to anyone right now. You can drill down to the nth degree in any service in any sector. So the same, in my opinion, has occurred to the comment that you made with the family office. They were very much known as obviously creating wealth by virtue of selling their businesses, and they would go to asset classes like real estate, which offered quite a level of return. And eventually, as the return profile changed, they started to realize, look, the most wealth we really generated was by divesting of our business and by doing and getting to this point. So they, in a way, started to kind of becoming again, I don't like to use that term because it does them injustice, but the way they went about it has a certain sophistication as well. And quite frankly, you could be talking to a family offices that has basically surrounded themselves with analysts or an investment officer, and not knowing enough detail, you could kind of miss the point that, hey, I'm speaking to a family offices versus a private equity firm. So fundamentally, like to echo, and I agree with you, perception is one way, but 25 years in, with all the focus into the middle market, with all the changes that have occurred and the processes and systems evolved, as long as it really behooves to the advisor to ensure who the proper buyer is.
Two questions in the audience. So Mark, and then up here.
So quickly, any more comment and questions in two situations by next year. One was with you're representing a buyer with buying a business from a family. I know it was a holding company, and really you had talked with the company for a long time with the owner of several businesses, one of them. What it really came down to is one of the Dallas and Davis American. So, everybody works planning goes to church. So you don't want to face them on Sunday. And so one of the keys was really making sure his people were taken care of. So it's really important that you were saying, go down and get to the reasons that they sell, what they want to accomplish. Having this discussion. So our client was set that this display. So we're checking software. Second situation is exact opposite. We represent the seller. Major, huge private equity firm from interest in our client, which is a small business, right? A very small business. And there's an intimidation factor, right? They made a bid, they didn't think the bid was high enough. They're there's that intimidation factor that somehow they're going to lose out. So as private equity goes out to all the strings, gamble, old lawyers and people, right? So you have an intimidation factor, you can't deal with private equity companies.
I think it's certainly there. I mean, ultimately, the advantage that family offices have over the private equity, as far as I'm concerned, are syncing and putting the vision of the founder and the private equity into play and matching them up so you have a real good match. And preparing the founder with a story that the family office really wants to hear, and preparing the family office with the story that the founder wants to hear. And after that, it comes down to the numbers are the numbers. So, everything else is what the legacy ultimately brings.
Yeah. And then we had a question up front here. Last question up front.
Most of them suggest liquidity is an issue from private equity, venture capital, etc. What's the solution to liquidity? Could NFTs, that fungible token, be a method of creating liquidity? It's for private investment opportunities. So let's say a private equity firm wants to get rid of or wants to liquidate, or an LP wants capital out. What we do is create an LP for a particular company, a net fungible token or net fungible tokens equal to the value of that investment opportunity, and sell it to LPs, other LPs that want that. So now you've liquidated. You've created liquidity where there was none, and create a market for that, a trading platform.
So from that perspective, and maybe the analogy is, from my part, that I'm about to say probably not proper, but when you look at alternative investments, which is exactly what you said, to create effectively a market to facilitate liquidity, as you indicated. Quite frankly, there's actually a lot of companies that are kind of trying to facilitate that. And obviously, private equity structures, when they raise their fund, they're previously, I think it was pretty straightforward, right? You would invest in it. You couldn't get your money out for a predetermined time, generally 10 years. However, as fundraising has become very prevalent, and obviously the ability for investors to invest in various funds, track record is certainly important, but there's other considerations, right? And one of the considerations is exactly what you said, and say, look, I would like to invest with you guys, but 10 years is just a very long period of time. And one thing that I believe we all can agree upon is return profiles and markets change in much more frequent cycles than 10 years. So that's certainly an opportunity for sponsors to kind of differentiate themselves and basically offer that as an opportunity for attracting capital and giving the opportunity to basically liquidate earlier. I think that's also an opportunity for family offices, to your point, to kind of come in, clubbing deals, right? I mean, generally, general partners, when they realize that there is tremendous amount of potential, even though let's say the investment horizon is 3 to 5 years for private equity firms, if they get to the 5th year and they realize there's still tremendous amount of value, they're more often than not will look to say, okay, who wants to stay in? We're not really ready to kind of divest or exit yet, because we've set up the processes, we developed the infrastructure, we created and expanded on the market. We want to take advantage of that. And that is an absolute fantastic solution to ensure that GPs or funds get to extend their investment horizon, all the while, facilitating liquidity for LPs that seek liquidity. And the market, as I said, that's why I kind of made the analogy with alternative investments, to kind of see development of that. There are companies that are more and more offering that opportunity. And I'll give you an example for private companies, name it OpenAI, Anthropic, or all the other companies. And I just named them because we like to stick to AI. There are already platforms where employees have the ability to divest of their shareholdings in, on the marketplace without needing to wait for the company to raise the next round of capital. So I've seen at least 5, 6, 7 platforms coming up, and more probably will come to market. And to your point, these NFTs are a fantastic way to facilitate the process with least amount of complexity that obviously entails it.
One thing that I've tried looking at tokenizing, and we're cross-border, And our attorney said that the regulatory challenges could be overwhelming because it's, across the globe.
I just want to add one thing from the tokenization in theory makes a lot of sense, but it's in practice, I think it's something that's way down the road. I think because secondaries, you talk to people who are secondary managers, they'll tell you the secondary deal done at 90%, both parties feel like they've won. And that's fair because the valuation, it's not a soft 85% and 92%. Problem with tokenization, you need to have standard terms. You need transparency. You have things in secondary interest, whether directs or LPs, right of first refusal. So having something that's transparent tokenization might make sense for other types of coins or other types of distributed ledger technology, but it's really not made for secondary interest right now. These are ecospheres where people have relationships, and the tokenization just truly commoditizes it, makes it completely open. I don't think we're there. Even the technology is there.
Which is a long-standing issue, a lot of tokens are issued during the ICO craze, is that you have to have a market maker after the tokens are issued, and nobody wants to be a market maker.
That's right.
Right, even if you put them on to Coinbase or whatever, nobody's making the market for them.
And there's valuation issues with the market makers as well. It's an excellent point Marty made. It's not like pricing. You take a lot of the ICOs, there's always been a lot of vagueness there, but having to be a market maker in a liquid secondary interest, particularly of LPs, is a challenge. I think evergreen funds are the closest things we're having towards more pricing transparency, where you can have those designated times to cash out.
It's just like today's secondaries. There's a lot of agents selling stuff.
That's right.
Secondary, right?
Correct.
But none of them sell unpopular secondary.
Well,
That's right.
but again, you need
Selling a
you need
pile is
something
different.
to lead, right? You need something to kind of create that market, and that's where I'm saying, in a way, I slightly disagree with you, Chris, because as I said, from a legislative aspect, we've seen already some of those coming in place. I agree with you. The regulatory framework needs to be in place internationally, but I mean, when you look at tokenization or even stable coins, I mean, when you look at the sheer number and when you look at the market that has been created and people really understanding the benefits that you can create and facilitating transactions, even cross-border, that's really why even I think it's been in the news recently. I think Bloomberg had a report, even the traditional financial institutions are looking into tokenization. They may not go the stable coin route because they don't want to necessarily heed or ultimately agree with some of the stablecoin issuers that they were right. So they're going the tokenization route in that concept. But fundamentally, it solves one problem. I have a transaction. I need liquidity. How can I do it with the least amount of time?
Again, creating a solution to a problem, right? A credit default swap moves the risk to the insurer that is providing insurance to the NFT. We can come up with other ideas to solve your points, which is that's what
So several years ago, while I was still at my former investment bank, we were doing a transaction in Turkey, and we had basically the buyer was local to Turkey, and the seller, and the buyer was effectively based out of Asia. And the biggest challenge we had ultimately to close out the transaction was the KYC process, the funding of the transaction, because the funds were effectively coming from international. And in all honesty, even though that was one of the first thing that I flagged, ironically, I think it was Citibank at the time, that we needed to kind of start the process as due diligence was on, as we started with the due diligence. Truth behold, 60 days later, we were still in this KYC process, right? And ironically, I mean, I may have lost my mind a little bit, and I said, I'm going to try not to swear as much, but I'm like, what are we doing? I raised this 60 days ago. And his response was, these are your, what rules. And I'm like, okay, fair enough. Let's kind of figure out how we want to close this deal, because everything was done, right? Seller was ready to close the transaction, buyer's ready. And here we are, how to kind of facilitate transactions. So to your point, had we had tokenization or anything else, I think this could have been bridged easily.
Say, there's because of the middle market, because the middle markets have been pushed out of the public exchanges in recent years. Do you think there's space for things like Texas Stock Exchange to come back?
Well, I-
Lower middle market companies being able to-
in prior life, I advised a company called T0, which was started by, of all places, Overstock, the the home fashionista retailer. But anyway, T0 was a tokenization exchange, and look, they were too early for their time back there 5 years ago, and I haven't kept up. But I personally believe in that, and I think there are some companies who never want to go public. They don't want the scrutiny of activists. They don't want the SEC style reporting, and the tokenization exchanges, I think, is the answer. But I think that this process is slow. We had a lot of disruptions with inflation and tariffs and market volatility and all that. And these types of things tend to slow down innovation in financial markets. But some large private companies tokenized a certain class of their securities to allow individual shareholders to trade and people to sell out of their incentive stock and let somebody else aggregate it. So I think it needs to mature. I think there needs to be more standardization because there are many small tokenized exchanges. And I think that if there's one day some kind of uniformity where the way people tokenize for one little exchange is the same as they tokenize for another, there could be a very interesting ecosystem where, folks who do private placement, like Reg A Plus, where you can do up to $75 million, will tokenize at the same time. And some private companies will tokenize to create liquidity for smaller shareholders trading with each other. I think it's an opportunity, but, it's not clear who's going to lead the way.
Last question.
Last
Yeah.
question.
Yes.
Last.
Crowdfunding has been here for many years. I think you just answer the Texas Stock Exchange question. I think the stat that people cite is 10% of the S&P 500 has roots in Texas or the Southeast. A major push to have a lot of back office, middle office jobs in the Southeast and Texas. But I think, why it was a little bearish on NFTs, secondary exchanges, the NASDAQ secondary market has been around for many years. And I think it's, you look at people private companies listing on the secondary exchange to tell their investors, hey, you can unload your shares on the NASDAQ private capital markets. It hasn't caught on. You talk to secondary managers, large and small, they'll tell you about their business is booming as much as ever, but there's a relationship aspect and there's the illiquidity. NFTs for liquid level one assets like GE is different than NFTs for alts. And I think that is a key thing where there's still a market for crowdsourcing and pricing transparency. I just don't think it's as simple as saying, let's have a standardized NFTs for alts. I just don't think we're there yet.
Last question. Second.
Well, I think
Yeah, go ahead.
Point about student organizations. When the company I founded, some providing organization, Portugal, major or top 8 traders of physical commodities.
What is it called?
Secret. I'm gonna give you a business card. So we already recognized almost $40 billion from transactions. We started in 2019, and we have in the market. So of course, there are use cases where this can be done. But guess what? All our customers are Europe.
Yeah.
But do you have an exchange where
It's funny.
they trade?
These are no regulated securities. So the next step of the education that must we get regulated, we can trade on the side. Was that a question?
I think just real quick, and I find it interesting that this comment was talking about that it was widely more used, I guess, in Europe than in the United States. That's certainly interesting. But to Chris's point, in terms of tokenization NFTs, I mean, ultimately, there is an asymmetry about risk, right? So the problem is And I think that's one of the reasons why it hasn't, kind of established itself. But again, the regulatory framework is being built. I think
Excellent.
the benefits of it are being seen pretty widely. And quite frankly, when you think about it, tokenization, stable coins, and they actually have the potential to uphold Bitcoin, right? Which is what it was intended to do. And more people are starting to realize with the acceptance of these type of methods and liquidity they can provide that it could potentially upend Bitcoin. So
Excellent. Thank you to my panel. It sounds like you could find these folks if you have more questions.